So I want you to try and imagine taking like 3 fully loaded Boeing 747s.
Okay, wow. That is a lot of mass.
Right, and you strap them all together, you put them on wheels, and you physically move them a full mile.
Yeah, that sounds like an engineering nightmare, honestly.
It does, but now imagine doing all of that using less than a single gallon of gas.
And that just sounds physically impossible.
It was exactly. But then imagine taking that exact same physical process, right, and repeating it millions of times across an entire continent.
Oh, and generating, what, almost $2 billion in pure unencumbered cash in just 6 months because of it?
Exactly. Today, we are looking at a company doing exactly that. And, welcome to this Special Talk Tickers edition of The Deep Dive.
Yeah, it's great to be here.
So when you hear the word railroad, it is so easy to fall into this mental trap, right? Like you picture rust and old steam engines and just, 19th century history.
Oh, totally. A Monopoly board game, basically.
Right. Yeah. You assume it's this legacy fixed-in-stone industry. But the data we are looking at today, it just shatters that assumption completely.
It really does.
We are pulling apart the Q2 2026 earnings call for Canadian National Railway. The ticker symbol is CNI.
CNI, right.
And what the source material reveals is, well, it's not an old-school railroad at all. It is a highly calibrated, high-tech logistics machine that is just quietly dominating the modern supply chain.
It really is the absolute definition of a structural moat hidden in plain sight. I mean, we are talking about a business that literally dictates the flow of the broader economy.
Absolutely. And our mission for this deep dive is to basically extract the signal from the noise.
Yeah, because there is a lot of noise in these earnings calls.
So much. We're taking that dense Wall Street jargon, the specific financial metrics, the corporate strategy that management outlined, and we are translating it into plain language for you.
Right, keeping it data forward, opinionated, and actionable.
Exactly. We are going to hit the talk ticker structure. So first, the headline numbers, then the story behind those numbers, what management is guiding for the future, and finally, the bottom line for you, the retail investor.
Sounds like a plan. Let's get into it.
So let's start at the very top of the income statement. Before we can appreciate the operational wizardry happening out on the tracks, we need to look at the cold, hard cash flowing into the business.
Right, the lifeblood of the company.
For Q2 2026, CNI reported revenue of $4.8 billion.
Wow.
Yeah, that is an 11% year-over-year increase. Now, I look at an 11% top-line jump in a legacy capital-intensive industry, and that feels massive to me.
Oh, it absolutely is.
I mean, a software company growing at 11% might be standard, but a physical railroad.
Yeah, that distinction is super crucial. When a software company scales, their marginal cost of delivering like an extra unit of software is practically zero.
Right. They just send another email with the download link or spin up a server.
Exactly. But for a railroad to scale its revenue by 11% in a single quarter, they are either physically moving a significantly larger amount of heavy material across thousands of miles of track, or they are demonstrating an immense amount of pricing power.
Or, as we're going to see with CNI, they are doing a highly strategic combination of both.
Spot on. And that revenue flows directly down to the bottom line, right?
It does. Adjusted diluted earnings per share, or EPS, came in at $2.08.
Okay, 2.08.
Yeah, which is also up 11% year over year. But in reading through the transcript, management specifically noted that on a constant currency basis, EPS was actually up 12%.
Okay, let's pause on that. Because CNI is a Canadian company reporting in Canadian dollars, but their tracks run super deep into the United States.
Right, all the way down to the Gulf, basically.
Yeah, the currency dynamic is a major factor when you're analyzing cross-border equities. Like CNI operates thousands of miles of track in the U.S. down to Chicago, Memphis, and beyond.
So they're doing a ton of business in U.S. dollars.
Exactly.
Yeah.
They charge U.S. customers in U.S. dollars. They pay their U.S. employees in U.S. dollars. They buy fuel in U.S. dollars. But when they report their quarterly earnings to Wall Street, they have to convert all of those U.S. dollars back into their reporting currency, which is the Canadian dollar.
Right. So if the exchange rate fluctuates wildly during the quarter, it can make their underlying business look, artificially better or worse than it actually is.
You nailed it. So by stripping out the exchange rate math, they are trying to show us the actual physical heartbeat of the business.
Yeah.
Constant currency is just management's way of saying, well, if we ignore the foreign exchange markets, the actual physical business of moving freight grew our profits by 12%.
Okay, that makes total sense. It is a much purer reflection of their operational execution.
It really is.
And speaking of that physical execution, the transcript leans heavily on this metric that is entirely unique to the transportation industry.
Yeah, RTMs.
Yes. They don't just tell investors, hey, we moved a lot of stuff. They use this metric called revenue ton miles.
Right, RTMs.
So for this quarter, RTMs hit 62.3 billion, which represents a 5% growth year over year.
Yeah, it's the ultimate measure of industrial output for a railroad. And RTM simply means the railroad transported 1 ton of revenue-earning freight for exactly 1 mile.
Okay, so give me a concrete example of that.
Sure. So if a farmer in Saskatchewan loads, say, 10 tons of wheat onto a train and CNI moves it 100 miles to a processing plant, that single trip generates 1,000 RTMs.
10 tons times 100 miles. Got it.
Exactly. So when management says they hit 62.3 billion RTMs, that means they essentially moved 62.3 billion tons of freight 1 mile.
Or like 1 billion tons of freight 62 miles.
Right. The sheer physical scale of what is rolling over their steel tracks is almost, difficult to visualize.
It is mind-boggling. And that immense physical scale is what generates the cash, which brings us to arguably the most important number in the entire transcript.
Free cash flow.
Yes, free cash flow. For the first half of the year, CNI generated $1.8 billion in free cash flow, representing a 19% increase.
1.8 billion, that's huge.
I really want to dig into this because free cash flow in the railroad industry is not the same as free cash flow in the tech sector.
No, not at all.
I mean, a railroad requires a staggering amount of capital just to exist, right? You have to buy steel rails, wooden ties, rock ballast, locomotives, specialized rail cars.
And you have to repair bridges and maintain signal.
Exactly. Across areas that experience brutal Canadian winters, no less. All of that is capital expenditure, or CapEx.
Which is why that $1.8 billion number is so incredibly impressive.
Right.
I mean, free cash flow is the cash a company generates after accounting for all those cash outflows to support operations and maintain its capital assets.
So they've already paid for all that upkeep.
Exactly. CNI isn't just generating $1.8 billion. They are generating $1.8 billion after they have already paid to maintain one of the largest infrastructure networks on the entire continent.
But that is wild. They are investing heavily in their network, and yet the business is so lucrative that it still throws off almost $2 billion in pure, unallocated cash in just 6 months.
Yeah, it's a cash printing press.
But as I was combing through the transcript, I noticed a metric that seemed to, contradict this narrative of total operational dominance.
Oh, you mean the operating ratio?
Yes, the adjusted operating ratio, commonly known as the OR. It came in at 62.2%, which is actually a 50 basis point increase.
Meaning it got slightly worse, yeah.
Right, compared to the same quarter last year.
So the operating ratio is essentially the holy grail of railroad metrics. It measures a railroad's operating expenses as a percentage of its revenue.
Okay.
It tells you exactly how many cents it costs the company to generate $1 of revenue. So an OR of 62.2% means CNI spent 62.2 cents to generate $1.
Okay, let's unpack this. So you want that number to be as low as possible, but it crept up. Now, wait a minute. We just established that revenue grew by 11% and EPS grew by 11%.
Right.
So if they're growing revenue by double digits, how is their core efficiency ratio getting worse? The transcript notes that this increase was primarily driven by higher fuel prices.
Yeah, fuel's a killer.
And it had a 210 basis point negative impact on the ratio.
That is the crucial caveat here. Fuel is one of the largest variable expenses for any transportation company. When diesel prices spike, it costs significantly more to move those Boeing 747s worth of freight you talked about earlier.
But here is where I am really struggling with the math. If fuel is costing them dramatically more, and it is visibly hurting their operating ratio by 210 basis points, shouldn't that eat into their profits?
You would think so, yeah.
Like if a local delivery company spends double on gas, their profit margins shrink, and eventually they go out of business.
Yeah.
But CNI's earnings per share still went up 11%. Why didn't the fuel cost crush the bottom line?
Yeah, it seems contradictory.
Is this just a mathematical quirk in how the ratio is calculated?
You are circling the exact mechanism that makes railroads such powerful inflation hedges. It is all about how fuel surcharges fundamentally alter the math of the operating ratio without actually hurting the underlying profit.
Okay, a fuel surcharge program. Explain that.
So when fuel prices spike, CNI doesn't just absorb that cost, right? They pass it directly onto their customers through a fuel surcharge.
Okay. Let's walk through a simplified hypothetical here so I can see the math.
Sure.
Let's say it usually costs CNI $60 in expenses to generate $100 in revenue. That's a 60% operating ratio, and they make $40 in raw profit.
Perfect baseline.
Now, fuel prices go crazy. It costs them an extra $20 in fuel to move that same freight, so their expenses jump to $80. But because of the surcharge, they bill the customer an extra $20.
Right, so their revenue jumps to $120.
Exactly. So follow that math through to the end.
The raw dollar profit remains exactly the same, $40.
Right. 120 minus 80 is 40.
Yeah. The fuel spike didn't hurt their actual earnings at all. But look what happened to the operating ratio. You are now dividing $80 in expenses by $120 in revenue.
80 divided by 120 is 66.6%. The ratio went up. The ratio got mathematically worse, going from 60% to 66%, even though the company didn't lose a single dime of actual profit.
It is entirely a denominator effect. By artificially inflating both the revenue denominator and the expense numerator by the exact same absolute dollar amount, the percentage relationship degrades.
That is wild. And that is precisely what happened here. Chief Financial Officer Ghislaine Hull explicitly stated on the call that the fuel headwind did not impact earnings per share.
Right. It purely distorted the operating ratio on paper. And this highlights a critical lesson for anyone looking at transportation stocks. You cannot look at the operating ratio in a vacuum during periods of volatile energy prices.
Right, you have to look at the EPS.
Yeah.
And it also highlights their pricing power. I mean, they moved 5% more physical volume, those RTMs, but they generated 11% more revenue.
Yeah, that spread is huge.
That spread between 5% volume growth and 11% revenue growth proves they are successfully commanding higher prices for their services, which completely neutralizes the sting of inflation.
Which naturally brings us to the operational reality of how they are moving that volume. Because, pricing power only protects you if the network remains fluid.
Right. You have to actually deliver the goods.
Exactly. To understand how they generated that 11% EPS growth, we have to look closely at the story behind the numbers. We need to look at the literal physical mechanics of the railroad.
So let's get into section 2, the story behind the numbers. The transcript points to a major internal initiative that management calls the Fast Track program.
Yes, Fast Track.
The chief operations officer, Pat Whitehead, noted they have already realized $100 million in savings year to date strictly from this program.
$100 million is nothing to sneeze at.
And this isn't from massive layoffs either. It's from eliminating waste and radically improving terminal productivity.
Rail yards are fascinating, chaotic environments. Like when people think of a railroad, they usually picture a train moving steadily across a prairie, right?
Yeah, exactly.
But the vast majority of a rail car's time and the vast majority of a railroad's expense actually occurs when the train is sitting completely still inside a terminal.
So walk us through what actually happens in one of these terminals, because a saving of $100 million just from improving terminal flow, well, that implies that there was an enormous amount of inefficiency there to begin with.
Oh, for sure. Imagine a massive train arriving from Chicago into a yard in Memphis. That train is carrying a huge mix of freight, right? Lumber, auto parts, grain, chemicals.
Right.
The train has to be physically broken apart. The locomotives are decoupled. Each individual rail car is sorted and grouped with other cars heading to a similar final destination.
How do they even do that?
They literally push cars over a small artificial hill. It's called a hump yard, and let gravity roll the cars down into dozens of different classification tracks to build entirely new trains.
That sounds like a giant heavy metal puzzle that has to be solved and resolved hundreds of times a day.
It absolutely is. And every single minute a rail car sits in that yard, waiting to be sorted, or waiting for a new locomotive, it is accumulating what the industry calls dwell time.
Dwell time. Okay.
Like, high dwell time is the absolute enemy of profitability. It means your assets are sitting idle, burning capital, when they should be generating revenue ton miles.
So the Fast Track program is essentially a microscopic optimization of that sorting process.
Exactly. It's about predictive crew scheduling, so a new engineer is ready the second a train is built. It's about dynamic routing, ensuring that classification tracks don't get jammed up.
Just keeping everything moving.
By reducing dwell time, the entire network becomes more fluid. And when the network is fluid, you need fewer physical locomotives and fewer actual rail cars to move the exact same amount of freight.
Oh, wow. That explains their labor productivity metrics, which are frankly staggering.
Yeah, the numbers are crazy.
The transcript measures this in gross ton miles per average employee. That metric hit 5,105, marking a 9% improvement.
9% is a huge leap in 1 year.
Right. Think about what that actually means on the ground. They moved 5% more total volume across the entire network, but they did it with a 5% lower average headcount compared to the previous year.
That is the textbook definition of operating leverage right there. They are squeezing significantly more output from fewer inputs.
Right.
But the optimization didn't stop in the rail yards. Once those trains leave the terminal, Fast Track is also dictating how they move on the open track. The average train length increased by 1% to 8,084 feet.
8,084 feet. That is over 1.5 miles of continuous steel and freight.
Yeah, it's massive.
If you are sitting in your car at a railway crossing waiting for that train to roll by, you are going to be sitting there for a very long time.
You're going to want to turn your engine off.
Definitely. But from an investment perspective, why is a 1% increase in train length such a massive driver of profitability?
It really comes down to the fundamental physics of rolling resistance. Moving freight on a railroad is exponentially more efficient than moving it on a highway because steel wheels rolling on steel tracks create incredibly low friction compared to rubber tires rolling on asphalt.
That goes back to the Boeing 747 analogy we started with.
Exactly. Once you overcome the initial inertia of getting that massive weight moving, it takes very little energy to keep it moving.
Right.
You already have the locomotives pulling the train. You already have the engineer and conductor being paid in the cab. You already have the dispatchers clearing the track ahead. The fixed costs of moving that train from point A to point B are already locked in.
So if you can physically attach 10 more rail cars to the back of that 1.5 mile long train, the marginal cost of moving those extra 10 cars is close to zero.
Bingo. You just burn a tiny fraction more diesel.
Which perfectly explains why they set a Q2 record for fuel efficiency. The transcript highlights an efficiency rate of 0.836 gallons per 1,000 gross ton miles.
That is incredible.
That is a 3% improvement. They are moving 1,000 tons of mass for an entire mile, and they are using less than 1 gallon of diesel to do it. It is mind-bending.
And all of these microscopic, incremental improvements, right? The slight reduction in terminal dwell time, the 1% longer trains, the 3% better fuel efficiency, the 9% boost in labor productivity.
Right. They stack up.
They don't just add up, they compound. They layer on top of each other to manufacture that $1.8 billion in free cash flow.
Okay, so that is the operational foundation. But a highly efficient network doesn't matter if you don't have the right freight to move.
True. You need stuff to put on the trains.
Which brings us to the specific commercial segments driving the top-line revenue. The commercial team, led by Chief Commercial Officer Janet Drysdale, flagged 2 massive standouts: grain and energy.
Let's look at the agricultural side first.
Yeah. CNI moved record Western Canadian grain volumes this quarter, hitting 18.4 billion RTMs, which is an 11% increase.
And the most impressive part of that record-breaking grain volume is how they handled it. CEO Tracy Robinson made it a point to highlight that CNI moved all of this incremental grain without needing to add new fleet capacity. They didn't go out and buy thousands of new grain hopper cars.
How is that physically possible? I mean, if you were moving 11% more grain, don't you inherently need more containers to put it in?
Not if you fundamentally alter the velocity of the existing containers. Management revealed they improved grain cycle times by a massive 15%.
Okay, let's unpack the mechanics of a cycle time. Because a 15% improvement sounds great on a slide deck, but what does it actually mean for the real-world farmers and the supply chain?
Yeah, so a cycle time is the total duration of a complete round trip. Imagine a single empty grain hopper car sitting at a rural farm elevator in Saskatchewan.
Okay, I'm picturing it.
It takes time to load it. Then it travels 1,000 miles through the Rocky Mountains to a massive export terminal at the port of Vancouver. It has to wait in line, unload its grain onto a ship bound for Asia, and then travel 1,000 miles empty back to that exact same farm elevator.
That sounds like a process that could easily take weeks.
It does. If that entire round trip takes 20 days, that single rail car can only move roughly 1.5 loads of grain per month.
Right.
But if you optimize the loading process, you smooth out the route through the mountains, and you reduce congestion at the port, you can drop that cycle time by 15%. Suddenly, that trip only takes 17 days.
Ah, I see the math here. So over the course of a multi-month harvest season, that exact same rail car can now complete several additional round trips.
Exactly.
By making the equipment move 15% faster, you are mathematically creating 15% more capacity out of thin air without spending a single dollar on new rail cars.
It is the purest form of capital efficiency. And they applied a very similar strategic mindset to the energy segment, too.
Oh, yeah, let's talk about energy. Petroleum and chemicals RTMs were up 11% for the quarter, but the specific catalyst here was refined products, which saw a nearly 30% surge.
Yeah, that 30% jump is wild. The transcript credits this specific surge to the April ramp-up of Phase 2 at the Greater Toronto Area, or the GTA fuel terminal.
This is where strategy moves beyond just running trains quickly and enters the realm of targeted infrastructure investment.
Totally. The energy industry doesn't just need trains. They need specialized facilities to safely and rapidly transfer liquid chemicals and refined fuels from rail cars into storage tanks or local distribution trucks.
Right, because you can't just park a mile-long train of highly flammable jet fuel on a siding in downtown Toronto and hope for the best.
No, the regulators would not love that.
No.
CNI saw a massive bottleneck in how fuel was being distributed into Canada's largest economic hub. Instead of just hoping energy companies would ship more fuel on their rails, CNI deployed capital to expand the offloading capacity at the GTA terminal.
Build it, and they will come.
Exactly. When you build a state-of-the-art facility that solves a massive headache for the chemical companies, the freight volume naturally flows to your network.
They built the infrastructure moat, and the 30% surge in volume was the direct reward for that. Which leads us perfectly into what was undoubtedly the most intensely discussed strategic topic on the entire earnings call: the Union Pacific agreement.
Oh man, this is where the narrative shifts from operational efficiency into a complete masterclass in long-term corporate strategy.
It really is. Let's set the stage for you listening at home. There is a massive mega merger currently playing out in the North American rail industry. Union Pacific, which dominates the Western U.S., and Norfolk Southern, which is a major player in the East, are attempting to merge.
Right, a true behemoth.
Now, normally when two massive competitors merge to form a behemoth, the rest of the industry panics. It threatens to lock out competitors and rewrite the entire balance of power.
Historically, yes.
But CNI didn't play defense here. They aggressively went to the negotiating table and secured two monumental agreements that essentially weaponized this merger for their own benefit.
Yeah, to understand why these agreements are so powerful, you have to understand the physical geography of the North American rail network, specifically focusing on the city of Chicago.
Chicago is historically the beating heart of the continental supply chain, right?
It is the ultimate bottleneck. Since the 1800s, almost every major rail line running east to west or north to south converges in Chicago.
I can only imagine the traffic.
Oh, moving a freight train through the inner city of Chicago is a logistical nightmare of intersecting tracks, passenger commuter trains, and just endless delays. It can sometimes take longer for a train to slowly creep its way through the Chicago metro area than it takes to travel across 3 entire states.
That is absurd. So whoever controls a fast route around Chicago holds an immense amount of leverage.
Huge leverage.
And years ago, CNI made a very strategic acquisition. They bought a smaller railroad known as the EJ&E.
Right, the Elgin, Joliet, and Eastern Railway. It is essentially a semicircle of track that acts as a bypass around the outer distance suburbs of Chicago.
A massive detour.
Yeah, it allows CNI trains to completely avoid the inner city congestion.
So they essentially own the private express lane around the worst traffic jam in North America.
That's a great way to put it. And Union Pacific desperately needs access to that express lane to make their own network fluid.
Right.
On the other side of the negotiating table, CNI has a strategic problem of their own. CNI's tracks run from deep in Canada down through Chicago, but they terminate in Memphis, Tennessee.
And the current manufacturing boom is happening much further south, specifically in Mexico. The nearshoring trend has supply chains moving out of Asia and directly into Mexican manufacturing hubs.
Exactly. CNI wants to connect the massive Canadian resource base, so the lumber, the plastics, the aluminum, directly to the factories in Mexico.
But they just don't have the tracks.
They don't.
Yep.
Union Pacific, however, owns the tracks from Memphis all the way down into Mexico via the Eagle Pass border crossing.
Okay, so Agreement 1 is a commercial swap. CNI lets Union Pacific run their trains on the EJ&E Chicago bypass.
Right.
In exchange, Union Pacific gives CNI a seamless, direct interchange in Memphis, allowing CNI freight to flow uninterrupted all the way into the Mexican rail network.
It's an incredibly elegant solution. I mean, the CEO, Tracy Robinson, noted this creates competitively advantaged growth and opens up a $3 billion addressable market.
So let's dig into that $3 billion number. Where is that money currently going if it's not on the rails today?
It is currently sitting on the highway. Right now, there is a massive volume of cross-border trade auto parts from Mexico moving to assembly plants in Ontario. or raw materials from Canada moving down to Monterey.
Right.
Because there wasn't a highly efficient single network rail option, a huge portion of this freight moves by long-haul truck.
But trucking is inherently more expensive for long distances, right?
Yep.
You have to pay a driver, you have to pay highway tolls, and you burn significantly more diesel fuel per ton of freight compared to a railroad.
So much more fuel.
Plus, the trucking industry is facing a massive chronic shortage of long-haul drivers.
By securing this seamless route, CNI can walk directly into that $3 billion trucking market and offer a structural advantage. They can go to the automotive companies and say, hey, take your containers off the highway, put them on our trains, and we will get them from Mexico to Canada cheaper, with less carbon emissions, and just as fast.
And CNI secured this revenue pipeline without having to spend billions of dollars laying down thousands of miles of new track through the American South.
Exactly.
That is just the first agreement, though. Agreement 2 is a settlement agreement. This one is entirely contingent on the U.S. government, specifically the Surface Transportation Board, the STB, approving the Union Pacific-Norfolk Southern merger.
Right, the regulatory side.
If the merger is approved, CNI gets trackage rights to Kansas City, access to the Neff Yard, and they gain the right to protect what the industry calls 2-to-1 and 3-to-2 shippers.
This dives deep into the regulatory mechanics of the transportation industry. The Surface Transportation Board exists primarily to prevent rail monopolies from gouging American businesses.
Okay, let me picture this. Let's say there is a massive chemical plant sitting in Louisiana. Currently, that plant has 2 different railroad companies whose tracks physically connect to the facility.
Right.
Because they have 2 options, those railroads have to compete on price to win the chemical plant's business.
That is a classic 2-to-1 shipper scenario. The plant enjoys the benefits of competition.
Right, lower prices for them.
But if those 2 railroads suddenly merge into one giant company, that chemical plant loses its leverage overnight. They go from having 2 options to having only one. They become captive to a monopoly, and their shipping rates will inevitably skyrocket.
Oh, the STB absolutely hates when mergers create captive shippers.
They despise it. So CNI used this regulatory reality to their advantage. They negotiated a settlement where if the merger goes through and creates these captive 2-to-1 shippers, CNI gets the legal right to run its own trains on the newly merged company's tracks to service those specific factories.
Wow. CNI positions themselves as the white knight preserving competition for the STB while simultaneously stealing incredibly lucrative freight contracts from their rivals.
It's brilliant. Plus, they negotiated trackage rights all the way into Kansas City, which is one of the most vital agricultural and industrial hubs in the American Midwest.
They basically get to drive their trains on someone else's tracks right into the heart of the Midwest, load up with new freight, and bring it back onto their own network.
Is corporate strategy at its finest. They looked at a mega merger that should have been a massive competitive threat, and they actively leveraged it to expand their own network footprint into the South and the Midwest, all while remaining highly capital efficient.
Okay, so we've seen the historical Q2 beat. We've unpacked the radical productivity of the rail yards and the strategic chess moves in Chicago and Mexico.
Yeah.
Now we need to pivot to Section 3 and look forward. What is management telling Wall Street to expect for the rest of 2026?
The guidance provided in the transcript is basically radiating confidence. Despite a murky macroeconomic environment, management actively upgraded their core forecasts.
They raised their full-year EPS guidance to mid to high single-digit growth, and more importantly, they raised their volume guidance, those RTMs, to low single-digit growth. In their previous quarter, they had modeled for volume to remain completely flat for the year.
Upgrading volume guidance in the middle of a fiscal year is a massive signal. It means their commercial teams have firm visibility into the order books of their customers.
Right.
They know the grain is coming, they know the energy products are flowing, and they trust their fast-track operations to handle that extra volume without letting costs spiral out of control.
But they are building this rosy forecast on a very specific set of macroeconomic assumptions. The transcript outlines exactly what they expect the broader world to look like.
Yes, the fine print.
They are assuming WTI crude, the benchmark for oil, will remain volatile, hovering between $80 and $110 per barrel. They updated their foreign exchange modeling to 0.71 Canadian for every US dollar. They expect their effective tax rate to hold perfectly steady at 25 to 26%. And they highlighted their leverage ratio, which is sitting at a very healthy 2.6x.
That leverage ratio definitely deserves attention. A leverage ratio measures a company's core debt relative to its earnings. Railroads naturally carry a lot of debt because of the massive capital requirements we discussed earlier.
Right, laying all that steel track.
Management's stated target for the leverage ratio is 2.7x, but they are currently operating below that at 2.6x.
What does that actually allow a company to do? Why should an investor care that they are 0.1x below their target?
It represents financial armor. When an industrial company operates with a healthy leverage ratio, it means they aren't suffocating under interest payments.
Oh, okay.
If the economy suddenly goes into a harsh recession next month, CNI doesn't have to panic and slash critical maintenance budgets just to appease their bondholders. It gives them the flexibility to play offense while their weaker competitors are forced to play defense. They can continue buying back stock, investing in terminal expansions, or aggressively pricing their services to steal market share.
However, management was also remarkably transparent about the risks and headwinds lurking in the back half of the year. CEO Tracy Robinson explicitly warned Wall Street analysts about a tough comp on Q4 for the grain segment.
This is a classic quirk of analyzing cyclical industries. Agriculture is inherently unpredictable. It relies on weather patterns, global geopolitical events, and fluctuating crop yields.
So when the CEO warns of a tough comp, she isn't necessarily saying that Q4 2026 is going to be a disaster for grain.
Not at all.
She is reminding the market that last year's Q4 was so incredibly, historically perfect, like a bumper crop move with unprecedented fluidity, that mathematically it will be extremely difficult to show year-over-year growth against that specific baseline.
Exactly. It's an expectation management tactic. If you hit a grand slam in the ninth inning last year, don't expect investors to be disappointed if you only hit a solid double this year. The underlying business remains exceptionally strong.
But the most fascinating headwind discussed on the entire call came from Chief Commercial Officer Janet Drysdale.
Oh, this part was super interesting.
She noted that overseas intermodal volume, meaning the standardized shipping containers coming off massive cargo boats from Asia, is expected to be weak at the Port of Vancouver. And her explanation for why it will be weak is what caught my attention.
Yeah.
She said the weakness is, well, in part related to the demarketing of certain low profitability shipments through the Port of Vancouver.
That single word, demarketing, is arguably the most important concept for understanding modern railroad profitability.
Wait, turning away paying customers implies they have a severe bottleneck and they are essentially kicking cheap freight off the train to make room for luxury freight?
Pretty much.
Is that what's happening at Vancouver? Why would a company that spent billions building a fixed cost network intentionally tell paying customers to take their business elsewhere?
You are hitting on the absolute core of yield management. Because a railroad is a fixed network, capacity is strictly finite. You only have a certain number of tracks running through the mountains out of Vancouver. You only have so many locomotives and so many trained crews.
Oh, that makes sense.
And not all revenue is created equal.
Let's visualize this. On one track, you have a massive tanker train filled with refined petroleum or specialized chemicals.
Okay.
The customer is paying an absolute premium rate for rapid, reliable delivery. The cars load quickly and they move efficiently across the network.
And on the adjacent track, you have a train loaded with overseas shipping containers filled with low-value consumer goods.
Right.
The ocean shipping lines negotiated rock-bottom rates to move those containers. Furthermore, intermodal containers require a lot of complex switching in the rail yards. They take longer to load onto the specialized flat cars, and they tie up massive amounts of terminal space.
So if the port is getting congested, that low-margin, high-headache container train is physically blocking the highly profitable petroleum train from moving.
Precisely. If you accept every single piece of freight offered to you, your network grinds to a halt. The cheap freight physically chokes out the premium freight. Demarketing is the deliberate, strategic decision to fire your worst customers.
Oh, it's like a high-end restaurant realizing they only have 20 tables.
Great analogy.
They aren't going to let someone sit there for 3 hours ordering a $5 plate of fries when there's a line of people outside willing to buy $100 steaks.
That is the exact dynamic. CNI is actively pruning the low-margin branches of their intermodal business to ensure the trunk of the network stays incredibly fluid.
Wow.
By kicking the cheap, slow freight off the tracks at Vancouver, they guarantee they have the capacity and the speed to service their premium grain and energy customers. They are intentionally sacrificing low-quality volume to protect high-quality margins.
That level of pricing discipline is what separates a poorly run utility from a high-performance logistics engine. They aren't chasing volume just to inflate their top-line revenue. They are obsessively chasing profitable velocity.
Yes.
Which brings us to the ultimate question. We have synthesized the massive operational improvements, the strategic maneuvering, and the aggressive yield management. We need to boil all of this down into our final segment, the bottom line.
This is where we answer the core mandate of the Talk Tickers format. What does this mountain of data actually mean for the retail investor listening right now?
Well, based on the raw data from the transcript, the operational story told by management, and the structural upgrades to their network, the opinionated stance we are taking on CNI this quarter is strongly bullish.
Very bullish.
The narrative here is not just positive. It highlights a company operating at peak efficiency while simultaneously laying the groundwork for a massive future expansion.
The investment thesis really crystallizes around three deeply ingrained structural advantages. First and foremost is earnings leverage.
Right.
This quarter proved, incontrovertibly, that CNI can widen their profit margins and generate massive free cash flow, again, $1.8 billion in just 6 months, by relentlessly squeezing more efficiency out of the assets they already own.
Right. They aren't generating that cash by recklessly taking on debt or buying entirely new fleets of trains. They are generating it through microscopic operational excellence.
Yeah, the fast track stuff.
Running trains that are 1% longer, turning grain hoppers 15% faster, and moving 5% more volume with 5% fewer people. They're essentially manufacturing highly profitable capacity out of thin air.
The second pillar of this bullish thesis is their strategic moat, which was fundamentally widened by those Union Pacific agreements. The rail industry is incredibly difficult to disrupt because you simply cannot build a new railroad today.
Oh, no way.
The environmental reviews and land acquisition costs would be impossible.
So growth has to come from expanding the utility of the network you already have. And by securing that seamless connection from Chicago down through Memphis and directly into the Mexican industrial heartland, CNI just unlocked a multi-year growth runway.
It's massive.
They are uniquely positioned to capture a massive share of that $3 billion truck-to-rail market. Their competitors simply do not have that single handoff access from the Canadian resource base all the way down to the Mexican assembly lines.
And the third pillar is macro resilience. We are living in a highly chaotic global economy. Between tariffs on raw materials, wild swings in energy markets, and shifting global supply chains, industrial companies are facing constant headwinds.
Yet, despite all of that chaos, CNI effortlessly mitigated the damage. They used dynamic routing to avoid congestion. They utilized yield management demarketing to prioritize high-margin freight at busy ports, and their fuel surcharge program acted as a nearly perfect mechanical hedge against inflation.
Exactly.
They're built to absorb economic shocks.
So let's make this highly actionable for you listening. If you currently hold this stock in your portfolio, the signals from management are crystal clear. They raised full-year guidance, which is the ultimate show of internal confidence.
But they didn't just offer optimistic words, they put their balance sheet to work. The transcript reveals they executed $454 million in share repurchases in this single quarter alone.
Well, $454 million.
When a management team aggressively buys back their own stock, it is the strongest possible signal that they believe the current share price severely undervalues the future cash-generating power of the business.
And if you are currently on the sidelines, trying to decide if CNI deserves a place in your portfolio, look beyond just the share buybacks. Look at the $2.8 billion in capital they are responsibly reinvesting back into the physical network this year.
They are replacing tracks, upgrading technology, and expanding critical bottlenecks like the GTA fuel terminal. They aren't resting on their laurels or milking the current assets dry just to boost short-term earnings.
Not at all.
They are actively building a fortress network that will be capable of handling massive future volume surges at incredibly low incremental costs.
But we do need to ground this bullishness in the reality of the industry timeline. The stock market often thinks in days, weeks, or at most, a single quarter. A Class 1 railroad operates in decades.
That is a critical point. While this specific Q2 print is exceptionally strong, the true massive payoff for this stock, the real alpha generation for a retail investor, is likely sitting out in the 2027 to 2028 timeline.
Yeah, it takes time.
That is when the complex integration of the New Mexico connections will be fully operationalized and the expanded energy terminals will reach maturity. If you are buying this stock, you are buying a long-term compounder, not a volatile day trade.
You are investing in the literal physical backbone of the North American economy.
Exactly. As we wrap up this deep dive, I want to leave you with one final forward-looking thought to mull over. It is something that wasn't explicitly spelled out in the earnings call, but it is the inevitable collision course created by everything we've discussed today.
Right, the trucking industry.
CNI is aggressively targeting that $3 billion cross-border trucking market. By leveraging their new Memphis to Mexico rail route, they are essentially walking directly into the trucking industry's backyard and planting a massive flag.
The logistics pie is only so big. If CNI is planning to take $3 billion off the table, the long-haul trucking industry is going to feel that pain immediately. And they're not going to just hand over their most lucrative routes without a brutal fight.
So the question you need to explore on your own is this. How long will it take for the trucking industry to retaliate, and what does that retaliation look like?
A price war, maybe.
Are we on the verge of a massive, margin-crushing North American freight price war, or will trucking companies be forced to radically reinvent their own logistics models?
Yeah, what if they adapt?
Exactly. Will we see a world where trucks completely abandon the long cross-border routes, integrate deeply with the railroads, and focus purely on highly specialized last-mile delivery just to survive against this highly efficient, structurally advantaged rail supernetwork?
The elasticity of demand in freight is about to be tested in a major way. It is a fascinating dynamic, and whoever wins that battle will dictate the logistics landscape for the next 20 years.
It is exactly why you have to read the transcripts and why you have to understand the physical reality behind the financial metrics. Thank you for joining us on this Talk Tickers deep dive. Keep looking past the headlines, keep questioning the assumptions, and most importantly, keep finding the story hidden inside the numbers.